YieldMax just announced a massive wave of reverse splits across a bunch of their ETFs, and investors are freaking out. If you hold any of these funds or you've been watching their high yield payouts, today I'm breaking down which YieldMax ETFs are about to reverse split, what that actually means, and how this affects your dividend income going forward. We'll cover the mechanics, the risk, and what smart investors should consider before the split takes effect. Let's jump straight into it. Welcome back to Simply Money. So here's the headline. YieldMax has announced reverse splits on a large chunk of their ETF lineup. And we're not talking small adjustments. Some of these are 1 for 10 reverse splits. That means every 10 shares you own become 1 share. The price gets multiplied by 10. The total value of your position, at least initially, stays the same. This affects several popular YieldMax funds, including ULTY, which will be a 1 for 10 split on November 28th. There's also CRSH, a 1 for 10, DIPS, 1 for 10, FIAT, FIAT, 1 for 10, MRNY, 1 for 10, and AIYY, 1 for 10, along with CONY, CONY, 1 for 10. And then there's a couple YBIT, TSLY, XYZY, ABNY, and OARK are all 1 for 5. Now the effective dates vary slightly, but most of these move into effect at the end of the month, right around November 28th for most of them. This is one of the biggest structural changes we've seen from YieldMax since launch. And it has a lot of investors wondering, is this a bad sign or just a cosmetic fix? Let's break down why this is happening. Reverse splits are almost always used when a fund's share price falls too low. In YieldMax's case, there are a few reasons this happens. 1, the dreaded NAV decay. These ETFs use an options income strategy that pays extremely high distributions, but a big portion is often return of capital, not pure income. Over time, that can erode the fund's NAV, meaning the underlying value slowly grinds downward. Second reason is the share price optics. A fund trading at $3 looks bad to the average investor. A fund trading at $30 looks healthier, even if the underlying value hasn't changed. Reverse splits make the fund look stronger, even though nothing fundamentally changes. And third, broker requirements. Some large platforms or institutional custodians prefer securities to stay above a certain price threshold. Below $5, trading rules can tighten. So YieldMax is essentially hitting reset on the share price to maintain liquidity and appearance. But this doesn't fix the underlying issues, it just restructures the shares. Here's the simplest way to understand a reverse split. Let's say you currently own 100 shares of ULTY at $5 per share. Yes, I know it's below $5, but we're just using $5 a share for the mathematical purposes of this example. So you have 100 shares of ULTY at $5 per share. That's a value of $500. After a 1 for 10 reverse split, your 100 shares become 10 shares. Price jumps to around $50 per share. Your total value stays roughly $500. Nothing changes in terms of total market value. Here's what does change. First, you have fractional shares. If the math doesn't divide evenly, you might end up with something like 9.6 shares. That 0.6 will be cashed out, and the cash may be taxable. Distributions don't stay the same per share, but they stay the same in total dollar amount, assuming the fund keeps paying at the same rate. Nobody magically gains or loses money just because of the split, but there are practical changes. So remember, if you have a 10-to-1 split, and you have a $5 share price and it goes to $50, and you have a 6-cent distribution, that'll go to 60 cents. It's multiplied by 10 as well, if the yield remains the same, and YieldMax obviously is intending to keep the yield the same if possible. What are the practical changes? Let's talk real-world consequences, both good and bad. What does not change is your total investment value. Immediately after the split, when the market opens on December 1st, your value is going to be exactly what it was when it closed on November 28th. They'll do the 10-to-1 split at the close of the market on the 28th, and you will have a tenth of the number of shares, but they'll be 10 times as valuable. The total value will be exactly the same. Your distribution yield percentage will stay the same. Again, ULTY is an example. The latest distribution was 6 cents. The next distribution after the split would be 60 cents. We don't know what the distribution will be the week of the split. It'll continue to be the 80% give or take yield that they're looking for in your ownership of the fund, because everybody's shares have been reduced by a tenth. So now the entire portfolio of, say, ULTY has a tenth of the number of shares outstanding as it did before the split. Here's some things that can change. Liquidity. Fewer shares means less volume. This can widen bid-ask spreads and make it slightly more expensive to trade, because you're going to remember there's a tenth less number of shares across the board. Secondly, price volatility. Higher priced, lower share count funds sometimes move more dramatically. Third is the psychological impact. Seeing your share count drop by 90% feels like a loss. Even though it isn't, many investors react emotionally and sell. The fourth thing that can change is the market perception. Reverse splits can be interpreted as a distress signal, especially in funds that rely heavily on return of capital distributions. And fifth, fractional share taxable events. We already touched on this, but if you get cashed out for partial shares, that's a small taxable event. Most people overlook this. And the biggest point here is a reverse split doesn't fix NAV decay. If a YieldMax ETF was slowly grinding down before, it may very well continue grinding down after. Now, I want to take a caveat here because we have been talking about ULTY as an example here. I am less worried about the reverse split with ULTY. I'm very intrigued with the underlying funds that they're holding. They've brought in things like Salesforce and other big companies, NVDY, that they're now doing calls on. So I'm curious to see how those impact their ability to slow down the decay and to see if the reduction can stay lower than the distribution. Because as the price drops, it has to drop less than the distribution over a long period of time. It might drop more than the distribution occasionally, but long term, if it continues to drop more than the distribution, it's a losing battle. I'm hoping these new underlyings will build up and begin to allow that to stabilize a little bit more. I'm more curious about that than I am the reverse split. But this video is about reverse splits. So before we continue, what are your thoughts down below? Whether it's on ULTY or any of the other funds, do you own any of those? Are you concerned about the reverse split? Do you have plans? What are you going to do before or after the split? Is it going to change anything you do? Leave a comment down for the community as we share with one another down below. That brings us to the question, should you hold, sell, or buy? Here's where strategy comes in. If you currently hold YieldMax ETFs, ask yourself this: were you here for monthly income, or were you hoping for price appreciation? If you're in this strictly for the income, the reverse split doesn't change your thesis, but it is a reminder to monitor the NAV erosion. If you were here expecting growth, reverse splits don't help that. Now, if you're thinking of buying before the split, there's no major advantage. There's also no major disadvantage, unless fractional shares cause that minor tax issue. But don't expect the split to magically improve fund performance. Now, if you're thinking long term, reverse splits are neutral mathematically, but negative as a signal. They're telling you NAV decay is real, the fund wants to reinflate the share price, and they may have hit price levels they want to avoid. It's not a disaster, but it's not a sign of strength either. At the end of the day, these YieldMax reverse splits are more about optics and price structure than actual performance. Your income won't magically go up, your total value doesn't change overnight, but the risk, NAV decay, distribution sustainability, liquidity, are still there. So if you're holding YieldMax ETFs, use this moment as a check-in. Does the strategy still make sense for your goals? Are you comfortable with the long-term NAV trend? And does the income offset the risk? Let me know in the comments. Do you own any of these YieldMax ETFs, and what's your plan after the split? If this breakdown helped, hit that like and subscribe button, and I'll bring you more updates on dividend ETFs and income strategies. I appreciate you joining me, and we'll see you next time on Simply Money.